We're going to first start with restricted stock units, which really is a form of compensation where employees are going to be granted shares of their company. Why is this done? Well, I think the hope from the company is that the employee is going to work hard and be a good steward of the company to move that company stock price forward and thus benefit the employee themselves as they receive those shares. The vesting period, so restricted stocks will vest to the employee. Typically, that's going to be time-based or it's going to be performance-based. So time-based would be, say, a 3-year vest, in which case shares would vest over a period of the next 3 years, and that would be contingent upon employment. Or it could be performance-based, which would be tied to certain achievements or certain corporate goals where those shares would then vest. So as we mentioned, vesting with restricted stock units, Susan, why don't you take this one and talk about when that vest occurs, what are those employees going to be looking at from a taxation standpoint?
Yes, this is a commonly overlooked compensation event. Depending on the fair market value of those shares on the vesting date, that will equate to W-2 compensation. So if the shares are valued at $100, you will be taxed on that $100 value of the shares on the vesting. What typically will happen behind the scenes, employers will withhold a portion of those shares that have vested to cover your taxes. The common misconception is that your taxes will be fully covered by the shares that are withheld. Unfortunately, for most people, the withholding is a little insufficient to fully cover your federal tax obligation on the value of those vested shares. So it's something we are consistently involved with clients for modeling out their compensation for the year and determining the exact amount of under withholding on the RSUs that are vesting so that you've got visibility and can potentially submit quarterly estimated tax payments to ensure that you're covered.
Yeah, and that could be a potentially large issue if these restricted stock units vest at a considerable amount or dollar value. If their withholding is, say, 20% or 22%, yet that client is in, say, a 35% tax bracket, there's a pretty big gap there. What are some solutions to that? Obviously, you want to plan, you want to be aware of that. What would you be advising as a CPA if a particular employee, has only a small percentage of their taxable income withheld?
So it depends, to be honest, on their personal objective for the remaining shares that they're retaining. If you feel confident about the company as a whole and you want to hang on to those shares long enough to realize long-term capital gains treatment, then you'll have to come up with another way of funding quarterly estimated tax payments. In a year where RSU represent a pretty significant portion of your compensation, you may actually be in a position where you have already met your safe harbor requirements, even via the insufficient withholding that's taken place, in which case you can potentially kick the can down the road until the following April to true up the remaining taxes. That being said, it's important to model this out and know what's coming down the pipeline. So if you have a major liquidity need in April of the following year, you're prepared for it and can plan for, either savings objectives personally or for liquidating of certain investments in time to pay the remaining tax liabilities.
That's great. Super helpful. So again, there's no difference really in the taxation of an RSU that vest or a cash bonus. The difference is that stock could appreciate in value from the time it's granted to the employee, right? The could be granted $10,000 of equivalent shares that appreciate to, say, $25,000 of equivalent shares. When those shares vest, all of that is going to be taxed as income to the employee, where if it was a cash bonus, right, you have that 10,000 is going to remain 10,000 in terms of the net back to the individual employee. So we kind of think that RSUs are really a cash bonus. It's in the form of stock, which can be positive and negative. It's a moving target depending upon the value of the company and what has transpired from the grant date to the vest date, because it all matters. When that stock vests, that is going to be the taxable event, and there's really no changing that or no deferral of that. Oftentimes, RSUs are going to be used as a retention tool. So the receipt of the shares, the vesting of the restricted stock units is typically contingent upon employment with the company. Now, if you leave the company, you could be forfeiting those shares. There are a few exceptions, retirement and possibly being let go. We've seen some areas where companies will still allow the vesting to occur. Sometimes there'll be an immediate vest, and it could be on a pro rata basis. But if you're leaving the company to go to another company, you're going to be leaving those unvested shares behind. So something to keep in mind.